In 2008, while the global financial system was collapsing in real time, something extraordinary happened behind closed doors. Banks were failing, markets were frozen, governments were panicking, and in the middle of the chaos, a private company, not a government agency, not a central bank, was quietly handed control over the cleanup. That company was BlackRock. Most people never noticed. But from that moment on, global finance was never the same. To understand why nothing about BlackRock is normal, you have to go back to a very different Wall Street. The late 1980s were an era of noise and arrogance. Trading floors were loud, risk-taking was celebrated, and success was measured by how much danger you could survive. In that world, Larry Fink didn't quite belong. He wasn't chasing thrills or headlines. He was fixated on something most traders ignored: the hidden dangers buried inside financial products. Early in his career, Larry Fink made a mistake that nearly ended everything. A flawed interest rate model caused his firm to lose around $100 million. On Wall Street, losses like that don't just hurt financially, they destroy reputations. For many, that would have been the end. But for Fink it became an obsession. He didn't walk away from risk. He tried to understand it so completely that it could never surprise him again. That obsession gave birth to BlackRock in 1988. It didn't start as a flashy investment firm. It wasn't built to chase massive returns. BlackRock was created as a risk management company. A strange idea at the time. Instead of asking, how much can we make, they asked, what could go wrong? And then they built systems to answer that question in brutal detail. Those systems would eventually evolve into something called Aladdin, a massive analytical platform capable of tracking and stress testing trillions of dollars in assets. Aladdin could simulate worst-case scenarios, market crashes, interest rate shocks, liquidity freezes. It showed what would happen when fear spread faster than logic. At first, few people paid attention, but slowly, the biggest banks in the world began to notice something unsettling. BlackRock understood their risks better than they did. By the early 2000s, Wall Street was drunk on confidence again. Cheap money flooded the system. Housing prices surged. Mortgages were handed out to almost anyone. Those mortgages were bundled together into complicated financial products and sold across the globe. Very few people understood what was inside them. Ratings agencies stamped them as safe. Banks collected fees. Everyone assumed the party would never end. BlackRock didn't assume. They modeled. They watched. They tracked the growing imbalance between risk and reality. By 2007, cracks were forming. Then came 2008. Lehman Brothers collapsed. AIG imploded. Credit markets froze. The financial system didn't just stumble, it seized up completely. Governments faced a terrifying truth. They didn't understand the mess they were supposed to fix, so they called BlackRock. This is where the story stops being normal. The US government hired BlackRock to analyze and manage toxic assets from the largest financial failures in history: Bear Stearns, AIG, mortgage-backed securities no one could price. A private company was now advising the Federal Reserve and helping stabilize the global system. BlackRock wasn't just watching the crisis. It was shaping the response. At one point, BlackRock was overseeing assets worth more than the annual economic output of most countries. They weren't elected. They weren't regulated like a bank. Yet they were central to the recovery. This wasn't illegal. It was unprecedented. And it worked. When the crisis finally eased, trust in banks was shattered. But trust in BlackRock skyrocketed. Pension funds turned to them. Governments turned to them. Universities, sovereign wealth funds, insurance companies, all handed over their money. BlackRock wasn't selling excitement, it was selling survival. And in a world traumatized by collapse, that was irresistible. Over the next decade, BlackRock grew at a scale history had never seen. By the 2020s, it was managing more than $9 trillion. That number is so large, it barely feels real. BlackRock owned pieces of nearly every major company on earth: Apple, Microsoft, Amazon, Google, Exxon, JP Morgan, not because it wanted to control them, but because its clients wanted exposure to everything. BlackRock became the silent shareholder of capitalism itself. Here's the paradox that makes BlackRock so unusual. It doesn't usually run companies. It doesn't make daily decisions. But it votes. It influences boards. And when Larry Fink writes an annual letter to CEOs about long-term sinking markets, listen, companies adjust their behavior not out of fear, but out of gravity. BlackRock's influence isn't loud, it's structural. Historically, power came from owning land, controlling armies, or printing money. Today, power comes from managing flows of capital, data, and trust. BlackRock doesn't gamble wildly like banks did before 2008. It simply positions itself as the safest place for the world's money to rest. Index funds, ETFs, retirement accounts. If you own the market, BlackRock is often standing quietly behind the curtain. This pattern isn't new. Financial history is full of quiet empires. Banking families in Europe once played a similar role. Invisible, indispensable, and deeply trusted. They didn't rule by force. They ruled by necessity. And like all systems built to prevent chaos, they eventually became too important to question. At its core, BlackRock's rise isn't driven by greed. It's driven by fear. Fear of another collapse. Fear of uncertainty. Fear of being wrong. Governments trust BlackRock because failing alone is worse than sharing power. Investors trust BlackRock because missing the market feels unbearable. The system trusts BlackRock because it seems too stable to doubt. But history carries an uncomfortable lesson. The institutions designed to stabilize the system often become the system itself. And when that happens, risk doesn't disappear, it concentrates. BlackRock didn't cause the 2008 crisis, but it emerged as one of its most powerful survivors. Just as past disasters gave us central banks and financial regulations, this crisis created BlackRock's moment. And moments like this don't fade, they compound over time. So, the real question isn't whether BlackRock is good or bad. The question is far more unsettling. What happens if the world's greatest risk manager becomes the risk? If something this large ever stumbles, there may be no one bigger left to call. And that's the part of the story we haven't reached yet.